You know that dream, right? Getting in on the ground floor of the next huge company? You see a name like Circle go public, and you hear all these stories about people making a fortune overnight. It's kind of the ultimate investing fantasy, isn't it? Get into an IPO, ride it to the moon. But what if I told you that for most of us, that dream is basically a mathematical illusion? Let's get into the brutal reality of it.
And this is the number that gets everyone's heart pumping. 168%. That's what Circle's IPO supposedly jumped on its very first day. When you see a number like that, the FOMO, it is just overwhelming. You're thinking, man, if I had just gotten in on that, I could have more than doubled my money in a single day. That's the siren song of the IPO market right there.
Yeah, but here's the thing. It almost never works out that way for regular people like you and me. That incredible first-day pop, that flashy number that's all over the news, it's hiding a much darker, much more brutal truth about how this game is actually played.
So, when you actually zoom out, the picture gets, well, pretty ugly. Look at this. Research shows that 3 years after going public, the average IPO gets absolutely crushed by the market. We're talking a cumulative negative return of almost 30%. That's right, while the market is chugging along, the average IPO is actually losing you a ton of money. So what on earth is going on here?
Well, the first thing we got to get straight is this. The IPO process is, and I'm not going to sugarcoat it, a game that is completely rigged against the small retail investor. Seriously, the system is not built for you to win. It's built as an exit strategy for the early, big money investors to sell their shares to you.
But I can hear you yelling at the screen right now. Forget 3 years. I'll just buy the IPO and flip it on day one for that huge pop. And you know what? It's a great idea in theory. The problem is you can't. And the reason why comes down to what's called the allocation game.
Just check this out. When a company goes public, something like 90% of the shares go straight to huge institutional players. We're talking pension funds, hedge funds, you name it. That leaves a tiny little sliver, maybe 10%, for everybody else. And this isn't just some small detail. This is the entire game.
And because of that tiny allocation, you run smack into this incredibly powerful force called selection bias. It's a simple idea, but it's brutal. The IPOs that are actually going to be huge, the ones that pop 100% or more, they are massively oversubscribed. Your chances of getting any shares are slim to none. But the IPOs that the big guys don't want, oh, you can have as many of those shares as you want. Your access is literally the opposite of the IPO's quality.
And this slide just lays it out perfectly. For that super hot IPO everybody's fighting for, you put in an order for 1,000 shares and you might get, 25 if you're lucky. But for that cold IPO that's probably going to tank on day one, your order for 1,000 shares gets filled, no problem. You see how that works? This one mechanism completely destroys that buy and flip strategy for us retail folks.
But okay, let's say you get lucky. You get some shares, or maybe you just buy them on the open market right after the IPO. There's another massive obstacle you have to watch out for. A totally predictable event that almost always sends the stock price falling off a cliff.
It's called the lockup expiration. So for the first 3 to 6 months after an IPO, insiders, we're talking founders, early employees, the venture capitalists, they are legally locked up. They can't sell their shares. But the second that period ends, the floodgates just open. A giant tsunami of selling pressure hits the market as all those early investors finally get to cash out their massive paper profits.
And don't for a second think this is some kind of accident. It's not. The system is literally designed this way. This is the whole point for insiders. It's their big chance to dump their shares on the public, often at super inflated prices, and walk away rich. You're basically buying what they are desperate to sell.
Okay, so I know this all sounds pretty doom and gloom. The game is tough, it's tilted, but that doesn't mean you have to be a sucker. If you actually understand these rules, you can flip the script. So let's talk about how you can build a much smarter strategy for even looking at IPOs.
All right, here's a smarter playbook. Number 1, just be patient. Seriously, wait for that lockup period to expire and for all that crazy hype to die down. 2, filter for quality. Only focus on companies that are actually profitable, not just some cool story stock. And 3, and this is a big one, avoid hot markets. You want to be most skeptical when IPOs are all anyone can talk about. These principles alone will help you sidestep the biggest landmines.
And when it comes to filtering, the data shows these really clear patterns. The IPOs that end up being winners tend to be companies that are already making money, have real revenue, and they go public in colder, more rational markets. The losers?
They're almost always unprofitable story stocks that run on pure hype and go public when the market is just euphoric. Your job is to ignore the story and just focus on the numbers.
So, let's put it all together. You take the tiny allocations you get in the winners and the full allocations you get in the losers. What does the actual math say about your expected return from trying to play this game?
It's negative. Yeah, you heard me right. Based on the data, accounting for the odds of getting shares in good versus bad IPOs, the average retail investor's expected return is negative 2.2%. You are, statistically speaking, set up to lose money over time, even with all those flashy winners you hear about.
So this all brings us to the real question, the most important one. It's not about how do I find a secret trick to win the IPO game. The real question is, knowing that the odds are so structurally stacked against you from the start, should you even be playing it at all? Or maybe the real edge is found in patience, in waiting for the hype to fade, for the insiders to finish selling, and then buying a great business months or even years later when it's just a regular stock and not a lottery ticket. That's really something to think about.